We've got a quick question here from Tong asking about base effects. He says that he's heard us use this term many times and just wants some clarity on what it is and how we use it. So base effects, in our videos or reports, you will from time to time hear or see us referring to base effects and its implications for incoming data. And it's actually a very simple concept to understand, but it is a very important consideration when you're looking at any incoming data. So economic data is often measured as or expressed as a month-over-month figure or a quarter-on-quarter figure or a year-on-year figure. So when you look at a data point, let's say it's monthly CPI data, like we have on this chart, your month-on-month or your month-over-month data measures how much higher or how much lower CPI is in the current month or the whatever month you're tracking compared to the prior month. So if you're tracking May CPI data, you're comparing that to the CPI in April, basically seeing whether it's came in higher or lower compared to the prior month. Similarly, when you're looking at quarterly data, you're comparing the prior quarter to the current one you're looking at. When you're looking at year over year, you're obviously looking at the prior year's data compared to the current data that you're looking at. Now, why are the base effects important? It's important because the base effect can skew the current or incoming reading that you get. So let's say that something very specific happened in a prior month. Let's take a recent example like Texas, where we had all of that bad weather, the blizzard hitting Texas with large parts of it shutting down. There was obviously, that was an unforeseen event. It was something that nobody saw coming. But as a result of that, you saw a big disruption in business coming out of Texas. And that means that the growth data, the CPI data, all of the data that we got from Texas for that month will obviously be much lower than they usually are. So when you get the next month data, like we had this month, comparing back to last month, once business has resumed and it's back to normal, the month-on-month or data of the next month will obviously look much better than it actually is, just because the prior month's data was skewed by whatever event it was. Sometimes it might be seasonal factors. Now, a very good example of this has been the pandemic in 2020, which has distorted so many of our year-over-year and quarter-over-quarter data points over the past couple of months. And now that we are going into quarter 2 of 2021, the base effects are going to potentially give us some crazy numbers coming out. So let's take CPI while we're on the screen, US core PCE as an example. It has been distorted obviously by quarter 2, the massive lockdowns that we have had coming out across the globe, not only in the US, of course, across the globe, but looking at US data, we had a huge drop to the downside in core PCE in the second quarter of the year. And the main reason for that, like we said, was the pandemic, was the economy shutting down. So having this as a super low base, obviously comparative to where we're coming from, having this as our base for the year-over-year numbers, once we get to May 2021 and or June 2021 and July 2021, there's a very good chance that we'll see upside surprises in the year-over-year numbers, purely just based on the base effects alone, because you're coming from such a low base. Now that the economy is running a lot stronger, businesses are running as, well, not as normal, but much higher and much stronger than we were running back in May, June, and July. Because of that, because of incoming fiscal stimulus, etc., there's a lot of anticipation that not only based on the base effects, but based on other measures, we're going to see some potential upside surprises in something like CPI data. Now, it's this base effect which causes some data points to be released with seasonally adjusted figures to basically try and counteract any drastic skews which might pop up in the data from prior months or quarters, where seasonal factors like the festive period could drastically affect the outcome. So think about your festive period when you normally see businesses on the retail side employ a lot of part-time workers, temporary workers coming in, and that can obviously skew your employment data on for the December quarter and the December month compared to the next quarter in January, etc. So you normally get seasonally adjusted numbers to try and counteract some of those base effects. Now, because a very low base effect can make the incoming data look much better than it really is, and a very high base can make the incoming data look a lot worse than it really is, it's very important for us to always consider whether we are coming from a very low base or a very high base when comparing incoming data. Let's take another example, which is GDP data for the US. Now, we had Due to the massive, massive slowdown, of course, in quarter two of 2020, we saw the biggest downside print in quarterly GDP ever, coming in below negative 30. Now, the reason why we had a very muted price reaction or market reaction from the print of the second quarter data is because it was widely expected that just based on the base effects alone, just based on the very low base of negative 30, that we were going to see a very solid number coming out for the quarter three data point. So that just shows you once again why it's so important to keep that base effect in mind. Because if you didn't know anything about the base effects and you get to your screen and you see, wow, GDP is printing at, plus 34% or whatever it was, you could jump into trades thinking, man, this is the best print I've ever seen. But the markets might already be expecting that just purely based on the base effects alone. So that is what it is. That's why we use it. And hope that's been helpful for you, Tong. Any other questions? Don't hesitate to let us know.